Well, hello, everybody, and a very good afternoon to you, morning, evening, wherever you happen to be. For us, it's afternoon. So a great warm welcome to you onto our webinar today, and delighted to be talking about credit risk assessment and insurance in turbulent times. And here we have the opportunity to gather some world industry experts to discuss key issues and opportunities. So before we go further, I'd like to introduce you to our speakers and welcome them to the session. A little bit of housekeeping. Do please ask us questions as we go through. If the question is pertinent to the point in hand, we'll try and answer it there. If it's a standalone question, we'll try and make a little bit of time towards the end of the session to address it for you. But let's introduce your experts. I'd like to start Gideon Jones. Gideon has had a career that's focused on risk management within the credit insurance industry, including leading roles in special risks, underwriting, claims, recoveries and collections, always though in an international environment. Gideon is a fellow of the Chartered Institute of Credit Management, and he is an acknowledged expert in the role of credit insurance and receivables finance. So good afternoon, welcome Gideon.
Good afternoon, glad to be here.
Thank you. Next, I'd like to introduce you to Robert Matters, who's Director of Global Business at Schumann and Director of Schumann International Limited in London. Robert has an academic background. He studied business administration and international management at the University of Economics and Management. He's been in the credit risk management industry since 1993, and he is well known for his forward-thinking agenda and his ability to look at the application of technology to solutions in the credit risk environment. Simon Peterman, our next guest. Hello, Simon. Is Factoring Coordination Manager for 12 factoring units across the CEE, based in Raiffeisen Factor Bank in Austria. And Simon is an experienced, acknowledged expert in factoring in Central Eastern Europe. And indeed, with all that's going on at the moment in Central Eastern Europe, delighted to have Simon to join us and bring his perspective to bear on what's going on there. My name is, thank you, Simon. My name's John Brattis, co-founder of WOA, a consultant in the industry with quite a few years operational, strategic and consulting experience. And it's really my pleasure to welcome you all to this afternoon session. Now, when we were planning the session, my colleagues asked me to say a few words of introduction to the session. I have been very tempted to ask ChatGPT to write this session for me, but I decided that no, you probably prefer that it would be based on real world experience. So what I've had to say forward is my own perceptions and not that of some chatbot. I think, we'd all agree that as we enter 2023, it's a difficult time for trade and its finance. There's been a lot of gloom and doom over the last few months reported. Although I have to say, I think perceptions maybe have softened a little bit in the last couple of months. For example, here in the UK, the stock prices of the one of the main stock indices, the FTSE 100, are at the highest level ever. But even if that is just catching up with some of the other indices, I think it's true to say that although there is perhaps an improving sentiment, global trade will still struggle during the coming year. For example, most European countries are going to see at best marginal growth, with the majority expecting GDP increases of less than 1%, if at all. The question, I think, is whether the global economy, which has really been teetering on the edge of a recession, can scrape through, or will recover. And of course, inflation, which has been driving the negative sentiment, looks as though it may now have peaked, but we still face a period of stagflation, low growth, high inflation in a number of economies throughout the coming year. And of course, governments have had to use high interest rates to curb inflation. And this has had the knock-on effect of greater probability of corporate failure and insolvency, holding back consumer spending, especially amongst those companies that have been described as zombies that have been struggling to survive even till now. Meanwhile, I think the emerging economies will continue to grow, but still showing higher but subdued levels of growth. And of course, they're starting from much lower bases. So on one hand, it appears that in touchwood, in general terms, maybe the worst of COVID, for example, appears to be behind us. But there is concern, for example, that avian flu could cross the species barrier. At the same time, energy prices are reduced due to the lower than anticipated winter demand that we've seen, and some alternative suppliers and routes have been secured. But this still remains volatile and could easily escape again. And it's taking time for those reduction in prices to work through the systems. And I hardly need to say that the continuing world tensions between the USA and China, with balloons and rhetoric and concern about electronic data gathering and economic warfare, the stresses relating to Taiwan. And here, of course, in Europe, unfortunately, the war in Ukraine continues, with at the moment almost a sense of stalemate with appalling attritional conflict. This, of course, could change dramatically, but it's unknown. And today's statement, State of the Nation from Moscow, hardly gives rise to hope that things are about to change. So we are facing an environment with a great deal of uncertainty and unpredictability, and all of this impacts significantly on credit risk and its management. So enough of an introduction. Let's find out what our panel think. So I'd like really to start perhaps with Simon, of course, because we mentioned that you're operating right across Eastern Europe, but you also have a presence indeed in Ukraine, in Russia, and Belarus. This is clearly impacting your business and the decisions you make in everyday sense. So I'd be really interested to understand how you are reacting to this as a business in a practical sense, and how you've had to adapt and adjust your business over the last year.
Mm-hmm. Well, thank you, John. Yes, we are definitely the biggest foreign bank right now in Russia, the biggest bank in Ukraine, and also the biggest foreign bank in Belarus. So the three countries there that have been affected or that are part of this war or invasion. And of course, we've seen, what can I tell you? Our bank branches being occupied and then liberated and then occupied again. We've seen, heroic things from our colleagues who are on the daily basis helping to keep the bank running, because you can imagine how difficult it is with the bombs, with the data centers and all of that. Can you imagine? We had our biggest data center in Kherson, which was for a time occupied by Russia. So a lot of things have gone on, but surprisingly, life goes on pretty much as normal. Of course, with the exception of the Donbas region and the bombs that tend to fall probably now and then. I'm saying every two days or 3 days, wherever they hit. But as mentioned, life goes on, and of course, also the agricultural business has been going on, even though they thought, it was thought that Russia is going to take over the major wheat and corn and all of this production land. But no, we were there. We supported, also first of all to finance the seeds and of course the technology, the tractors, the combines and all of that. So of course also, people need money even in occupied territories. People have gone there, service that, and yeah, these are our heroes, I have to say. But surprisingly enough, especially as mentioned in the west of Ukraine, and life goes on. Russia, life goes on as nothing has happened. If you listen to the television or see, the Russians don't even feel it in that sense, except for a couple of companies that went out. But of course, we were also expecting all these, energy shocks that were predicted, and because the vicious, the forecast by credit insurers that there will be a lot of defaults in these countries. That did not fully materialize, or the predictions were not as pessimistic as they were. It didn't come out that way. I think we avoided the recession mostly. I'm not talking about Ukraine. We see a 30% decrease of GDP in this year. But I mean, in Europe, except for, I believe, if I read correctly, the UK is one of those few countries that is being hit very strongly. But again, Russia. I was just reading the Guardian this morning, where there was an analysis that, again, we're not sure about the statistic. It looks like it's local, so we cannot be fully sure, that even the recession in Russia is only about 2.5%. Of course, probably it's not that little, but it's not as much as was expected. So yeah, we've seen this kind of balance out. Of course, it's a globalized world, and if you don't get it from west, you get it from the east. But all in all, the claims caused by buyers in Russia defaulting, on the receivables to the west did not materialize, or did minimally materialize, because most of the buyers found ways to transfer their funds to their suppliers through banks that were still working there. I mean, Raiffeisen is a non-sanctioned bank working in Russia. What we will do with that bank in Russia and Belarus is a question for our bosses, for our board. We're looking into options, of course, what to do, how to work with that. But again, life still goes on. The business goes on, and the only problem we see right now is that, of course, there is no cover available for Russia and Belarus at the moment. Ukraine, there are still some covers available.
So it's interesting. I mean, in one sense that you're suggesting that there was a sort of, it's too strong a word to say business as usual, but business not as affected as badly as you might have expected.
Exactly. This is a bit of a surprise after 1 year, which we're seeing that of course, again, probably even in Second World War, people had to eat, people had to produce. There's still that going on. As mentioned, Ukraine has been hit hard, and of course there's, as mentioned, 30% decrease. But of course, life needs to goes on, and business still needs to go on. People still need to, use telephones. On the other hand, it brings in some of that industry that then starts to develop a bit more, of course.
Mm-hmm. And in terms of the activity, in terms of where businesses are operating, have you seen business failure? Have you seen the need for a greater call on insurance?
If we're talking about Russia, Ukraine, no, they're not, because again, it's a specific situation. Of course, the states are supporting, but also in other cases. I mean, surprisingly enough, what we saw, where we were as Austria surprised, because of course Austria is a stepping stone for Russia. I mean, there's a lot of Russian companies, like a hub in a sense for Russians to operate further out into Europe before, let's call it before the war. And now, of course, that is obvious. Also for Ukrainians, there's a lot of Ukrainians living right now in Vienna. You see the cars parked everywhere. But we didn't, surprisingly enough, there was not real problematic cases in getting our let's say payments done, or really no defaults that we huge defaults. Of course, there's always is, but of course, pharmaceutical industry is not sanctioned, so business still goes on. Certain things are still not sanctioned, so business still goes on as usual in certain cases, of course. Mm-hmm. But of course, the production or producers turn to other markets when losing Russia, they turn to other markets afterwards.
I mean, just taking for the example of Ukraine, one of the real worries was that the impact of Ukraine and its being the breadbasket of the Western world, its wheat exports, etc. And again, I think that's one of the reasons why the overall GDP has dropped significantly, as the loss of exports. But that again, at this stage, you think hasn't necessarily fed through to impacts within the domestic economies?
No, it has. I mean, of course, there was a huge impact. But what happened was, the flexibility. Even as you saw, what we thought that we were going to be left without gas because we cut off the Russian gas, and we found other providers like the U.S., the Qataris, and everybody else. Same thing happened with this. Of course, it cannot go out in ships. That was the main way of exporting, but means of exporting. But now, of course, it found its routes through Romania, through Poland, through other countries on trains, and from there on further. So it's been hit, but of course, people are finding their ways, and of course, we're always been innovative, and especially in these difficult times, people are always innovative to find their ways out of that.
Okay. So that's good. And this innovation is also in the production, but are you also seeing innovation in the terms of the way people are looking for finance?
True, but I have to say, at the moment, when it comes to Ukraine, I mean, Russia, we've stopped financing or growing in that sense. So I mean, Russians need to take they find their own resources within the Russian banks. But when it comes to Ukraine, I think that hunger for new money has kind of dropped a bit. And they've all, I have to say, a huge number of people have moved out of Ukraine, and they're finding that financing outside of Ukraine, so in the West. So we've seen that very much strongly, let's say, in the Czech Republic. We don't have a bank anymore in Poland, but we're hearing that Poland is a big financer right now of local. But Romania definitely is a huge financer. Hungary again is not in best relationships with Ukraine, but definitely Czech Republic, Slovakia, Poland, and Romania are taking the big burden and financing. I have to also say there's a lot of people working from home from these countries.
Right. Okay. Well, thank you, Simon. That's a really interesting picture of what's going on, and how people are managing to be quite resilient despite most extraordinary pressures. Perhaps I could move now to Gideon, and Gideon, perhaps we can look at the sort of the broader scene. I mean, we've had this very specific geographical area, but how do you see the issue of credit risk assessment and insurance in the more general sense in the wider economies? You know, what are you thinking? What's your experience, and what are your expectations, for example, in claims and insolvencies in the wider European and world economies in this coming year?
Yeah, I mean, I think I'd probably go back to your introduction a little bit. If you think about, I've been involved in credit insurance and collections for 40 years now, and seen quite a few risks stimulated by one thing in the main, whether it be a bit before my time, but the oil situation in the 70s, but the credit crisis in 2008. Normally, it's a single stimulus which triggers things off. So what's been really amazing over the last couple of years is the sheer number of diverse issues which we're looking at. So apart from the war in Europe that you and Simon have been elucidating on, you've got some other mega trends going on. You've got shifting trade patterns. You've got the Brexit situation, which is between Europe and the UK. You've got all of the inflationary elements, commodity price hikes, fiscal policy, high interest rates now featuring, and not least COVID. So, I mean, the really fascinating thing about being in credit insurance is that whatever's happening out in the world actually reflects very directly on the business that you're doing. And if you look at the where we are now, somebody just said, well, it's surprisingly not as mad or abnormal as you might expect. And in some respects, that's actually true as well for credit insurance. The credit insurance continues to grow. The Bern Union, which produces overall industry statistics for credit insurance, shows that short-term credit insurance has grown a further 4% in the last year that it reported. Our own figures within Atradius mirror that. So there's appetite out there for credit insurance. The volume of cover that's put into the market by the credit insurance equally. I mean, there was a shift during COVID, but that was more to do with following actually what was happening in the real economy than any necessity to cut cover. In fact, just to sort of pause on that COVID thing for a moment, one of the big differences between 2008 and the COVID situation we had a couple of years ago was that there was almost immediately, the pandemic became apparent, there was a very swift response between governments and the credit insurers, as well as banks, as to what measures needed to be taken to ensure that the worst impacts did not materialize. In our case, it meant, how can we put ourselves in a position where cover is maintained and avoid unnecessary problems. So schemes were created which enabled that to happen. What did also happen during that period was that companies who weren't trading, of course, you don't need the cover, so you were able to reduce the cover provided to those companies who were trading in a much reduced level. But now we see that that's rising back up again. What we saw also during that period was collections actually reduced very, very heavily, dramatically. Almost reductions of about 50% of what we would normally receive in terms of collection cases. And this is because of the other government initiatives which were pumping money into the real economy to sustain those businesses. So they were awash with liquidity. Therefore, companies were paying their bills. So the amount of business. At the moment, our predictions are that that insolvencies will continue to rise. We're going to see that continuing through 2023. Two main reasons for that. One is that there are a lot of pressures out there, in particularly in the SME part of the market. I mentioned interest rate pressure. The cost of debt service is going to be increasing dramatically. But also remember that the insolvency regimes in various countries, UK included, were actually suppressed for a couple of years during the pandemic. That's now lifted, and there's a bit of a cleanup going on. So we're seeing something like a 32% increase in insolvencies being reported year on year, and that's going to work through for the rest of the year. So yeah, if you think how credit insurers report their businesses, they talk in terms of loss ratios. So what we're talking about there is, if you measure the total volume of premium and then take off the claims and allow back for the recoveries you make, it gives you a sort of like a percentage, and that's on the rise, unquestionably. I'm not just talking about Atradius here. Both COFAS and Allianz Trade, the other two big credit insurers, are all reporting that their loss ratios are rising, and they expect them to rise further as we go through the year. All of the pressures which are on businesses right now will be feeding through, and I suppose the caveat I would make is that you've got to watch your generalized data like this, because it covers a wealth of sins, doesn't it? You need to look much deeper. You need to look who's at risk.
Yes. Oh, thank you for that, Gideon. I think the reaction that immediately I have is again that somehow almost the same as Simon was saying at the beginning, that despite some quite dramatic events, quite dramatic pressures, that I won't say people are taking it in their stride, but there isn't quite the sort of the extreme reaction that maybe there has been to pressures in the past.
Yeah, I think the journey over the last couple of years has been potentially highly volatile, but because of the measures taken, and I think pretty good management in partnership with governments, but also by the participants within the market, within the credit management market and the financing market, we have not seen the worst impacts. It doesn't feel anything like as bad as
Okay, fine, thank you. So that's interesting. Now, what I'd like to try and explore is, what might be going on that actually allows for a more efficient and effective dealing with the shocks and the stresses and the strains. What is actually helping with decision making, risk assessment, monitoring. The idea of how we approve credit limits and such forth and manage those exposures. Perhaps I could bring in Robert now to share with us some thoughts on this. And Robert, perhaps you can talk us through a little bit how you see, in reference to some of these trends that are going on, how the environment is changing and what is actually happening in terms of technology, for example, to allow people to make more measured, more careful reactions to the stresses and strains that the economy is facing for us.
Yeah, so thank you very much, John. Well, as Gideon said, the business needs to respond to the economic environment, and they've ever done that. So whatever comes up, and in your introduction, you took it from a global view that the global trend is that we are expecting a slight and slow increase of the GDP in 2023. So it's something more or less 1.0, some say 1.4%, but never knows exactly. So it's something that it's moving in this right direction. And what does it mean for lending business, for example? There are expectations that there is also an increase for everything in the space of finance lending. So there are some positive signs, and they are backed that supply chains stabilizing, and expectations that China is moving back to the global supply chains again. And I think especially Asia, Latin America, and also Africa, I would assume that global trade is improving. So what does it mean? There are positive signs, but they are on a lower level, but a recovery of the overall global situation. And of course, you need to have a closer look in the country-specific and world region-specific environment on the one hand, and the sector you're talking about, the industries. And I want to underline that this is a very, very important topic when we are talking about insolvencies. So there are expectations, as Gideon underlined, that of course insolvencies will increase. Maybe there will be a rise plus 19% or something, but well, it will be definitely above what we saw in 22, because in 22 we saw for example, governmental aid and everything that's coming from the COVID-19 situation. So everybody was wondering a bit what happens in 22 because of the very low level of insolvencies, but I think there will be a change. And what we see is that there are already some indicators, for example, payment, late payments, what we recognized in the databases, payment areas by borrowers, and we expect that this will getting a bit worse, and let's see what the insolvency rate will be sector-wise, industry-wise. That is very important, because some industries are highly impacted by the cost increases coming from energy costs and the supply chain disruptions that we saw in the COVID-19 period and last year. So there will be a recovery. However, I think some companies will struggle a little bit with that. So what does it mean in terms of the credit risk management? So credit risk management is very much key in handling business in a volatile economy, in changing economy. And I think it's very important to get a clear view what the credit risk portfolio is in your company as a bank, financial institution, on the corporate side, as well as the trade credit insurance companies do. They have a clear view what is the expected default rate sector-wise, country-wise, and down to the individual company. And that's very important to get a clear overview over the entire credit portfolio. And IT, of course, you mentioned IT can help here. What are the prerequisites? So, of course, it's data. You need to get historic data, but of course, first and foremost, current data into the system coming from rating agencies, and analyzing the payment experiences on your own to see exactly, is there anything that is indicated to a higher default rate in the future. And taking that into account, the next step would be to have a closer look at how you want to perform in the market. Maybe you have to amend and adjust your credit policy, so to decide upon the business that you want to do. If you are, for example, in the field of receivables financing, of course, what are the portfolios that you want to get into your books on the one hand, and what is the policy regarding the limits? And it's very much dependent on your policy with the trade credit insurance. So it's crucial that you have a close cooperation with the trade credit insurance. And what I heard also from Gideon and from the market is there is a capacity available. And what I heard from the ICESA, the Global Association Trade Credit Insurance and Surety Bond business, is exactly the same, that there will be also capacity available for banks and financial institutions supporting the business. So the signs are clear into the direction. Of course, the overall message is capacity is available, but the big but is you need to have a closer view on the world regions, countries, and the sectors you're in. Of course, the risk quality will be monitored by each party, whether it's the financing party, it's a corporate, or the trade credit insurers. They all monitor exactly the risk and the default rates. And yes, there are expectations that claims will increase. However, it's very much dependent on how you are managing your risk in your books, and to make it visible and transparent. Where is the risk? Where could you locate the risk? Only the global view on that does not fit. In these days, it's very important to look at that sector-wise, country by country, and of course the individual risk. And another thing, what is very important from my view, where IT and software could help, is that all the processes related to risk mitigation, so that means trade credit insurance coverages, to support that by technical interfaces. So as soon as you want to apply for a limit, to increase the limit, reduce the limit, and the communication between the parties, it's very important that you organize that in a most efficient way and have up-to-date data. Coming back to the point that as soon as you're adjusting any policies with the trade credit insurers, of course you need to adjust your processes immediately, and there are self-services and IT solutions available. What does it mean? So that you could adjust your processes immediately on your own, so that you could ensure that you fulfill all obligations between the parties. And maybe one word would also refers to what Gideon said regarding the debt collection, and that also relates to the debt collection. So to organize that in an efficient way is very important to get cash in. And there are technical solutions. For example, we have interface to Atradius debt collection and other players in the market. So what I want to underline is we are all sitting in the same boat, and the parties could connect also with IT and technically and electronically. There are lots of initiatives coming in also from parties to support transformation into digital processes to support that. And we are in that context and helping the related parties to perform in a better way, and to support them to handle credit risk management in such an environment as we see that today. And I think that this is one of the key messages, the cooperation between the parties, to have close cooperations, close communications, and efficient processes available to support all that what we want to reach.
Okay, excellent, thank you. Just again, a reminder to the audience that we are available for questions and comments. So if you have anything that you'd like to share with us or ask the panel, don't be shy. Do please apply. Robert, thank you for that. I think the point there about what are the developments, what are the trends. And you're talking about this transformational into digital processing. I'd like to perhaps open that question both to Simon first and then Gideon. If I could ask you, sort of as people at the sharp end of the users of insurance services, what do you see as the likely biggest influences, developments, changes in the provision and application of credit risk assessment and insurance in this coming year? What are the things that people attending this webinar are going to be needing to look out for? What are the things they're going to see changing this coming year? Simon, perhaps if I could put that to you, as from the bank's perspective, what's going to be the obvious change?
I mean, for the banks, the biggest change is that we're back to what's called a bit of normalcy, because the interest rates have been historically low for the past 17 years, and if we put that into perspective, that's when the iPhone was invented. So since the iPhone was invented, we've had low, historically low interest rates. Now, the fundamental question is because the banks kind of lived on these interest rates being, because that kind of fed the lending from that side, and since that went 17 years ago, it was the ground taken out from the banks. So, and they were floating in about zero gravity, as it would call them. So what happened was banks in the last couple of years really turned to the products that generated fees. And so it was just about fee business, and what they also did is they turned into silos. We have this transaction banking silos, then have a trade finance silos, and you have the cards silos, and all of them function by themselves, trying to find where they can find fees. Now this is kind of turning back and giving fresh air, as we call it, jet fuel for the banks to start renovating. And one more thing, maybe just to mention, fintech has jumped up, suddenly, because there were cheap cash and new ideas, and of course cheap investor money. So what is happening is there are about a couple of trends that we see. Okay, banks will re-innovate ourselves. When it comes to that, we'll definitely invest into a lot into new products, especially for taking care of risk. How to manage the risk, how to see the limits, how to manage limits, where to allocate limits, all of that. And predominantly, it will be a lot of automation. AI is jumping out. All of that. Digital transformation is the big word. And of course, hopefully, they will break down these silos and again try to take care of the client in its full range, not only in each product by itself. Just mentioning talent is something that is the biggest thing that banks will have problems with, and this is exactly where the right risk people that will need to come, that understand the business. But even more than that, comes back to the IT, because banks have become, or bankers have become IT employees in a sense. They've become, in a sense, what is more problematic is banks used to be the employer of choice. Now they're not anymore. So how do you bring in the talent that will care of that that relationship with risk and managing that risk? So this is probably a new paradigm that was sustainability. We can talk about. Branches are coming back. That's something just to mention. It used to be that branches were not of interest at all. They were obsolete. Now it seems that this personal contact is coming back. But maybe something that will be definitely interesting is Basel IV when it comes to that. Basel IV and CRR compliant policies with credit insurers. This is something that will definitely be a paradigm that will change how banks perceive risk and how to cooperate with credit insurers. I think this is something that is especially important. How this will work out, let's see. Let's see when Basel IV comes out. But we already see this starting to move, and I'm sure this will quickly come out. And another thing, fintechs are not anymore disruptors, but enablers. That's maybe another point that will help. Also, in the means of risk assessment, supporting the analysis of risk, things like that. So I think those are the biggest trends that are coming. One is more, it's called the metaverse, but that's something that's a bit outside of our scope a bit at the moment. But AI and all of these.
Okay, fine. Thank you for that. Gideon, from your perspective, from the credit insurance industry's perspective, what do you see as the likely biggest influences, developments, changes this coming year?
So I've got a bit of a shopping list. Some are actually collections, some are credit insurance. I mean, data. Let's talk about data. Robert was talking about the, we're all, we're none of us standing alone. I mean, in order to run an efficient, effective credit insurance or collection operation, you need good data. So that has always been the case, but the sheer scale of the inputs and how their deliverization and systems can speed up the processing.
Gideon, I'm going to
working on.
interrupt you interrupt you just for a second. I think your internet's connection may be a little bit difficult because we're losing you. Would it be possible just to put you on voice just for a moment?
Yeah, can you hear me?
Yes, we can hear you perfectly now. Thank you.
Okay, sorry. So I was talking about data as an input into our processes. The intelligent use of data. So we're using data to help define what our collection strategies are in our collections business. By understanding the quality of the database, you can understand what might be the best collection strategy to deploy. That's one point. We're also seeing, to get onto that point about fintechs, are involved.
I think we may have lost Gideon for a moment.
Investors that should something go wrong, somebody can step in. So we see that as a fascinating and growing segment. We're also seeing customers who are using debt collection services, late stage debt collection services, now wanting to explore actually fully outsourcing collections, so that they're passing the whole AR management through to Radius Collections. That's a service which is growing in our area. We're putting a lot of effort in using technology to support that. I'm going back to credit insurance for a moment. Sorry to jump around, but yeah, the Basel IV and how to make our credit insurance policies compliant with the rules that are required by the Basel IV regulation. That's a critical area. I know that we have teams working very actively on that with banks and with other partners to make sure that we can go as close to the needs of the banks, so that they can be as capital efficient as they can. So a big area of work for us.
Excellent, thank you. And I think, as ever, we've got through our time for the webinar very rapidly. We've covered a lot of ground. Just before we finish, I just wonder if I could ask each of you for a 1-minute answer on your key takeaways from the discussion from today. What do you see as the most important issue for our audience, the most important messages for our audience on this topic of credit risk assessment and insurance in turbulent times? Robert, if I could ask you, put you on the spot, your 1-minute key message for the audience.
Yeah, I think the key message for the audience is getting transparency, what kind of business you're doing, what the risk portfolio is, to analyze that into deep, and set up IT supported processes to handle and manage that. And talking about that kind of IT support, that means that there are end-to-end processes that you could set up so that you're embedded as a company, whether it's corporate bank, financial institutions, via clever IT solutions connected to banks, financial institutions, to trade credit insurance, and not to forget for long-term engagements, for example, in terms of investments into construction, etc., surety bond business. There are also digital processes available, and you can make use of that. There are lots of initiatives coming in to digitalize processes. That is the future, and you have partners available to transform your business into the right direction.
Excellent. Thank you very much, and a very good, concise answer there. Simon, equally, I pass to you. Your 1 minute key takeaway for the audience.
Well, I think the key takeaway is we survived the year, which we thought was going to be a disastrous year, quite well, but that we're not out of the woods yet. So I think we need to be prepared. I think being aware that there's risks out there that we need to collaborate with insurers, with collection companies, with companies with, let's say, fintechs who help us analyze and predict that risk is a key point to do right now and invest in. Again, especially from the banks that we're back to normal, so to say, and we're getting the money and as I said, rocket fuel. Now's the time to invest. We will probably move into the cloud. So the cloud is something that's happening here. Also, these fintechs and insurers are already helping us. And if we utilize all that power, I think we can get through this year also without scratches, too many scratches.
Too many scratches. Well, let's hope that's the case. Okay, that's great. And Gideon, your again for you, please. Your 1 minute takeaway message for the audience.
Yeah, I think I go straight right back to the beginning, the environment. All the expectations are that the risk environment is going to get tougher. We're seeing that. The volume of collection cases placed is one of the lead indicators for what's coming. And you know, we're currently running at something like 100 million euros a month of late stage collection cases being placed. That's now beyond where we were in 2019. It's growing. So that measure, that lead indicator, the insolvency predictions, and all of those environmental elements that we've talked about are all talking about a much rougher risk environment for the coming year. So the key message really is, you know, we believe in long-term relationships with our customers, both credit insurance and collections. And indeed, this is the time to work closely together in collaboration, because when times do get rough, those relationships and how we work together actually is highly beneficial for all parties. So it's going to be a time to roll our sleeves up and get ready for, I think, a pretty tough 12 months coming.
Excellent. Okay, thank you very much for that, Gideon. Well, we're almost coming to the end of our session, and for me, I think it's been very illuminating that we've found ourselves in a situation where over the last year there has been a huge amount of uncertainty, a huge amount of volatility, and I think that we all agree that you know, whilst we've been surviving, it isn't all over yet, and there's a lot more volatility to come, and I think great more pressures. But I think one of the key messages for me that's come out of this conversation is that actually the importance of collaboration and partnership and actually tackling the challenges. You know, no man is an island. It is actually through working together corporately and individually that actually our ability to deal with these pressures improves and increases. And so I think for me that's a very important message. So it just comes to me to actually thank our panel for your in-depth thoughts and analysis today, and for sharing your expertise and knowledge with the audience. We really appreciate the time and effort that you put in it, and I'll speak on behalf of the audience and thank you for your expertise, your opinion and analysis. And with that, I will close the session and thank everybody who's participated. Thank you to the audience. This will become available on the website, and we will be holding further webinars during the course of the year. And I suspect that a little bit down the line, one of the topics that will be creeping up the agenda will be indeed Basel IV and compliance and the impact that will have on the receivables finance industry. So with that, thank you all very much, and we wish you a very good day. Thank you, everybody.
Bye.
Thanks. Bye-bye, everyone.
Bye-bye.
Thank you. Bye bye. Thank you.